In today's lesson, we want to look at accounting equation. It's one of the topics in accounting that you must always encounter, or the examiner will always want to see your level of understanding, in whatever exam you want to write, be it WAEC, NECO, JAM, or even external exam, international exam. As far as that exam is accounting related, you must see one or two questions on accounting equation. So in today's lesson, we want to take time to explain what accounting equation is all about. But before then, let's peep through what will serve as guide to today's lesson, what I call the objective of today's lesson. What are we looking at? At the end of the lesson, what do we intend to achieve? Number one, we want to see if we'll be able to define accounting equation. Can we define accounting equation at the end of this lesson? Number two, can we describe in a nutshell what a balance sheet is? Number three, can we summarize the effect of transaction on the balance sheet? And then can we solve related questions? If we are able to do this, then we've been able to achieve our objective. Now, like I said before, our success criteria will be determined by our ability to be able to define accounting equation, describe a balance sheet, summarize the effect of transaction on the balance sheet, and then solve related problem. Let's go. Now, the first thing I want to explain here is what accounting equation is all about. We have a very positive and significant relationship with mathematics. If you want to go into accounting as a course or as a discipline, you must be grounded in mathematics, because there are some mathematical tools that will be used to explain certain transactions in accounting. Like for this particular topic now, you see that he's talking about equation. In mathematics, we have the likes of simple equation and so on and so forth. So if you want to really do very well in this topic, you must understand the concept of simple equation. We have quadratic equation, we have polynomials and the like. But for this particular topic, you must understand simple equation. Now, an accounting equation is simply an equation that expresses relationship between asset, capital, and liability of an organization. Every organization has a foundation. The foundation of every organization is their asset, their capital, and their what? Liability. The totality of financial accounting is based on the accounting equation. I said it, that it serves as a foundation. It serves as a foundation to every company. And then you cannot do very well in accounting without a proper understanding of what accounting equation is. Because if the organization is centered on asset, capital, and liability, then an accountant that is not able to navigate through the relationship will not be able to do well. That is why it is very necessary that we take time to explain what accounting equation is. And then the next thing you should understand under the definition is that the principle of double entry is developed from the axioms of what? Accounting equation. Accounting equation is more like a compendium, a summary, of what double entry principle is. Let me refresh our mind on what double entry principle is. Double entry principle is a principle in accounting that states that for every debit entry, there must be a corresponding credit entry and vice versa. That is to say that for every time you receive, you must be ready to give. So the ones who receive is to be debited, and the one who gives is to be what? Credited. If we have understood that, then we make progress. Let's look at what the equation is. The fundamental equation is given as assets is equal to capital plus liabilities. If you observe this, you see that asset comes with an S. That means it's not one, it's more than one properties. All the properties of a company, put all of them together, must be equal to the capital, what is introduced to start up the business, and the claim of outsiders. This will lead us to one concept that I want to explain: sources of revenue to a company. What do I mean by sources? Every company has a particular source through which they generate their resources. And I want to tell us that we don't have any other source or sources apart from the owner of the business and the public. The owner of the business, the proprietor, the proprietress, or what we call the director of a business, must introduce part of his property or properties to start up the business. It can be cash, it can be what? Property. If a man that want to go into school, that want to establish a school, he can decide to divide his building into two and take part of his building for classrooms, part of his building for the administration, and then part of his building for extracurricular activities. Now, this part of the building that is introduced into the business form part of the capital introduced. And then he may not have everything. He may not have all it takes to build a school. He might need to source funds from the public. So the money that is generated from outsiders constitute what we call the liabilities. So if at the end of the day, you want to find out how much you have, then you are going to measure, or you're going to value every property under the control of the company. You value their plant and machinery, you value their land, you value their furnitures, you value their fittings, all of these things. When you add all of them together, the money you should realize should be equal to the money that is introduced into the business and what you are expected to pay. If for any reason your asset is not equal to your capital and your liability, then there is a problem. That is why we said it is very, very fundamental. Now, permit me to take us to what the balance sheet is, because as you can see there, this is just like what is expected to see in the balance sheet. We have explained that balance sheet is simply a statement that shows the presentation of a summary of assets and liabilities in a well-arranged form, so that the financial position of an organization may be what? Clearly ascertained. I want to request that students should take time to read what a balance sheet is, because for the sake of this lesson, we may not go in depth. We might just touch the items of a balance sheet so that we can make progress in our lesson. I have explained, I said, it talks about what? Asset and what? Liabilities. We will also take a glance at what an asset is. We said an asset is a property that is owned, controlled by an organization that has the ability to generate economic benefit or future benefit to the organization. And they are divided into fixed and current. We said they're fixed, they are assets that can last for more than 1 year, and then the current, they are assets that may not be able to last for more than 1 year. Now, when you talk about assets that can last for more than 1 year, we are talking about properties that is owned and controlled by the business that can generate future economic value beyond 1 year. That is to say that their lifespan is more than 1 year. And we have land and building, we have plant and machinery, we have furniture and fitting, we have motor vehicle, etc., etc. Students are advised not to limit their knowledge of assets to what I have listed so far. There are companies whose asset goes beyond that, and there are companies whose assets are not up to that. The nature of the company and the service or product involved in the company or produced by the company will determine their kind of asset. Somebody that is into manufacturing and somebody that is into construction may not have the same classes of assets. Somebody that is into service and somebody that is into extraction or extractive company may not have the same nature of asset. The asset varies with what? Companies. And then durability also. What we mean by durability is that the lifespan of an asset also depends on the the strength of the company. The company that is worth 3 billion cannot be compared with a company that worth 1 million naira. If you are company worth 1 million naira, that means you might see an asset that is about 10,000 in nature. But that 10,000 naira asset in another company that worth 1 billion or 2 billion might just be an expense. So it varies. Students should not be rigid with their knowledge. They should be flexible enough to know when to change the examples or the nature of their asset, because examiners can bring transactions that may be extracted from a financial statement of a company that worth billions. And by the time you begin to see certain classes of asset that is not listed here, you will say that you have been misinformed. Please, you have to think out of the box on this particular asset. And then the same thing with current asset. Current assets, basically they are assets that cannot last for more than 1 year. They are stock, what we call inventories. They are cash, they are bank, they are debtors, they are bills, receivable. The same thing applies to this. This classification varies with what? Companies. Now, liabilities, I said earlier that they are claim of outsiders over the business. They are obligations you are expected to pay someone in either money or money worth that is outside the company. And then they can be divided into two, or they are divided into two. They are long-term or what? Short-term, or we call current or non-current. Now, when the liability is something that you are expected to pay within 1 year, it is called short-term or non-current. It's called short-term or current liabilities. But when it is more than 1 year, it is what? Long-term or non-current liabilities. The example of long-term liability, they are capital, long-term loan. When I mean by capital, like I've said earlier, that capital is what is introduced into the business. We are going to that by the time we look at the equation proper. Now, the short-term or current liabilities involve creditors, people that you are owing, bank overdraft, that's a permission or grant by the bank to withdraw more than what you have in your account, short-term loan, bills payable, etc., etc. Now, there is a table that will really give us the true picture of what we are talking about. You have a transaction, we have an effect on assets, we have an effect on capital, and we have an effect on liability. Every single transaction has an effect on your assets, have an effect on your capital, and it has an effect on your liability. Remember from the beginning we said one of our objectives is to find out or to understand the summary of effect of transaction on the balance sheet. And the balance sheet is simply the statement that shows your asset and your liability. So to what extent can we say that a transaction affects the balance sheet? Now let's look at the first one on this table. We have introduction of capital. When the proprietor or proprietress introduce money into the business, how does it affect the balance sheet? Now let's look at this. We said our equation, accounting equation is equals to what? Asset is capital plus what? Asset. Because capital plus what? Liabilities. So every transaction must affect either of these. So let's assume that we introduce capital. Let me assume John introduced 10,000 naira cash. John, started business with 10,000 what? Cash. Okay. This is a transaction. Let me write the name of the person. John started business with, let me write it well, sorry. John started business with 500,000 naira cash. What is the effect of this transaction on this equation? That is what we are looking at. John started business with 500 naira cash. It's a very straightforward transaction. Now, first of all, you know that money introduced to start up a business is what? Capital. So you write capital first. Then they said this money was actually introduced in cash. In cash. So since the money was introduced in cash, you know that cash is also what? Affected. So the two transactions that is affected here, they are what? Capital and they are what? Cash. Then you ask yourself, when we are talking about current asset, when we talk about current asset, we mention stock, we mention debtors, we mention cash, and then we mention what? Bank. So in this case now, when John started business with cash, 500,000 cash, that means capital has increased. So capital is affected. And the what? Asset is affected. What part of asset is affected? Cash. You see now? So if you want to represent it, if you see from that table, you see that there is an increase. There is an increase in cash. You say increase in cash. Increase in cash. How much? 500,000. If what we were having before, we were having 200,000 before, by virtue of this introduction of 500,000, it has increased to what? 700,000. And then increase in what? Capital. If this person introduced capital before, what maybe 10,000 before, and has introduced another 500,000, 10,000 plus 500,000 is going to increase. 500 and what? 10,000. So now the effect is that capital has increased and the what? Cash has increased. That is just the summary of this table. So if you look at now introduction of capital, you have increase in cash, increase in asset. Under effect on asset is increase. Under effect on capital is also what? Increase. In bracket you see cash. Now purchase of goods on credit. Purchase of goods on credit. If we say this same John bought goods what? 20,000 naira on credit from Mary. John bought goods worth 20,000 on credit from what? Mary. You first of all ask yourself, now he didn't pay. Already he didn't pay. He bought these goods from Mary. Remember we have said that the equation is between asset, capital, and what? Liabilities. These are claims of outsiders over the business. This is what the owner of the business introduced, and this is the worth of the business. So when we say bought goods worth this, what is going to happen is that if we were having, let's assume we are having 50,000 worth of goods in the company, and we have bought 20,000 naira, that means it's going to be what? 20 plus. It's going to be what? 70,000. That means our stock has what? Increased. So stock is affected. Our stock has increased. And then because this person, John, didn't pay, it has also increased our what? It has also affected our what? Liabilities. It affected our. So what is going to happen now is that now because stock, he bought these goods on credit from Mary. Our stock, which is asset, is what? Affected. Stock. So you come here and you write. You say it has increased our stock. Increased stock. Stock has increased by what? 20,000. And then what's the next thing again? The next thing that happens there is that there will be an increase in what? Liability. Increase in liabilities, 20,000. Because since he didn't pay Mary, we are still going to pay Mary at the end of the period. So increase in stock. This stock is an asset. So it will be increase in asset and then increase in what? Liability, and so on and so forth. If you look at it, the table will give you a clear picture of what we are saying. Sales of goods on credit, it will increase your assets. And it will also decrease your asset, because when you sell your goods, the stock that you have will decrease. That's why you see debtors in bracket. The stock, you see stock in bracket here under asset. The stock of goods you have, it will do what? Decrease. And then because you are selling on credit, your debtors will also do what? Increase. So that transaction affects the asset in two ways. It increases your stock and decreases your debtors. And then settlement on creditors by check, your liability will decrease. And then what will happen to your asset? When you settle your creditors, your creditors will decrease. And then because it's by check that you are settling them, your bank will also be affected, and that bank is asset. So your asset is expected to also decrease. And then cash drawings for personal use. When you take money from the business for your personal use, you see that money that you have taken from the business, if it is cash, it will reduce the cash. That is why you see decrease here. And then it will also decrease your capital. The money you introduce into the business will also be affected. Payment to creditors, just take time and go through the table, and you will appreciate the effect of transactions on the balance sheet. Let's quickly take an illustration from the exam guide so that we can have a clear picture of what we are discussing. Now, if you go to your exam guide, you see something like this, and then you click on account. When you click on account, because that is the subject of interest, so click on account, you go to the year. You can choose a particular year of interest. You can choose 2019, 2018, the particular year of interest, and then you see questions that relate to accounting equation. But for the sake of this lesson, we have clicked on random. This random, we just want to pull all the necessary questions from each of these years that relate to accounting equation. And then once you have done that, the topic of interest is what? Accounting equation. Then you click on get started. All the questions under this particular topic will just pop up. So far we have two questions here that we want to solve to further explain what we said so far. The first one said, Eze introduces his private car into his business. The aspect of accounting equation of the business that will be affected are, it's very simple. He said, Eze introduces his what? Private car. First of all, you know that asset will be affected, and you know that capital will also be what? Affected. Why will asset? Look at this. He introduced his private car. Look at this. Introduce his private car. Introduce his private car. So, private car. Now, the first thing you should know is that private car here represents an asset. It's a motor vehicle. Something, a product that can last for more than 1 year. So, by virtue of this introduction, if we were having 3 cars before, introducing one will make it what? 4. So, first of all, asset is affected, and then capital is affected. Now, what is the nature of the effect? Asset will increase, and then capital will also do what? Increase. They didn't ask us the nature of the effect. They only asked the part of the effect that it will have. The effect is that it will affect asset and what? Capital. So the answer is what? A. Let's look at the second question. All right, they said, which of the following is not correct? All right, okay. Which of the following is not correct? Let's look at it. We have said that asset is equal to capital plus liability. So what we are going to do, we are going to use our mathematical tool, the calculator, or we can simply manipulate it on the board to find out which of this is not correct. Now, the one that is not correct is the one that this one and this one is not equal to this one. We said asset is equal to what? Capital plus what? Liability. So that anyone that when you add up capital plus liability is not equal to asset, that is the one that is not correct. Let's start with A. The first one says 78,500 is equal to what? 12,500 plus 66,000. If you add up this, 6, 6, 1, 2, 3, 12,500, 0, 0, 5, 8, 7. This is 78,000 what? 500. Number 1 is correct. This one is correct. Let's go to, this is A. Let's go to B. What is B? B says 95,550 is equals to 11,500 plus 84,000 what? 0, 5. When you add this, you have this value. So this one is correct. Let's go to C. We want to find out the option that is not what? Correct. C says 82,000. 1, 2, 3 is equal to what? 28, 1, 2, 3,000 plus what? 54,000. 54. Let's add 54,000 plus what? 28,000. 0, 0, 0. This is 12. You carry 1, 7, 8. You have what? 82,000. This one is correct. You see, by experience, since A, B, C is correct, even if you don't calculate again, you know by default that D will be the answer. But since it's accounting, we have to be very, very sure. We are always objective. So we have to check the D part to be very sure, because the examiner might even give you something that is also correct. And in his mind, he wants to tell you that the answer is not there. So you want to prove whether you want to find out if you know what you are doing. So don't assume by the time you get a student will be say, okay, since these three are correct, you took. If the D is also correct, then you are correct. Then you are wrong. Let's look at D. What is D? D is 65,400. Is equal to what? 11,200 plus what? 54,200. So let's go. 54,200 plus 11,200. This is 004. This is 5. And this is 6. 65. I said it. This is 65,400. You can see now that the answer is not there. This is 004, 5, 6. So you have 65,400. If you were in a hurry to conclude that okay, since 1, 2, 3 is correct, this particular question is a setup. If you choose D, you are wrong. So what you do, what I recommend at this point is that you skip that particular question, leave it back. There is no answer. You just skip it because all the options given here, they are all correct. And the question is, which of the following is not correct? The examiner really wants to find out if you understand what you are doing. All right, so far we've been able to define what accounting equation is. We said accounting equation expresses relationship between assets, capital, and liabilities. And then we have said that it is the foundation under which the double entry principle is what? Developed. And we said double entry principle is a principle that states that for every debit entry, there must be a corresponding credit entry. And then we looked at the balance sheet, because since it is centered on asset, liabilities, and capital, you can't talk about it without making having an overview of what balance sheet is. If you say balance sheet is a statement that shows asset and the liability of a company within a period of time. And we said assets are properties owned and controlled by a business which has the ability to generate future economic benefit or value. And they are divided into fixed, which we call non-current, and then current asset. We said fixed asset can last for more than 1 year, while current asset cannot last for more than 1 year. Examples of fixed asset: plant and machinery, land and building, furniture and fitting, etc., etc. And then current assets, they include stock, which we call inventory, debtors, which is called accounts receivable, and then we have cash, bank account, pay receivable, and so on and so forth. And we have said that we shouldn't limit our knowledge of asset to what I have mentioned, that it varies with companies. Then liabilities are claim of outsiders over the business. Claim of outsiders, the obligation, what you owe the outside world. When we say outsider, these are people that contribute to the welfare of the business. And they said it is divided, or they are divided into two. We have the ones that you are expected to pay within 1 year. We call it short-term or current liabilities. Example: creditors, bank overdraft, short-term loan, bills payable, and then the ones that you can pay after 1 year or 2 years or thereabout, depending on the agreement. They are what? Capital. If you open a business and then you hand over that business to somebody to manage that business for you, you introduce 1 billion into the business as capital. You don't expect that capital to be recovered within 1 year. Maybe it will take 4 or 5 years. Within that period of time, the manager of the company is expected to give you back that capital or to recover the capital, maybe through accumulated profits. So capital is always number one when it comes to long-term liabilities. And then we have what we call long-term loan. You can go to the financial institution like the bank or the microfinance, and then you access loan for a very long time. And then we've looked at some illustration. We have a table that gave us a summary of effect, and we said when money is introduced into the business to start up a business, it will affect your asset, which is cash, and it will also affect your capital. It will increase your asset and increase your capital. Now, when you buy products on credit, it will increase your stock, which is asset, and it will also increase your liabilities. You know, we gave a summary of it on a table, and then we have looked at we've solved some related questions from our exam guide. We recommend strongly that students should go to the exam guide to solve more questions on this, so they can be grounded and rooted on the subject matter.